If someone handed me $1,000 today and challenged me to grow it into $100,000, I would not look for a lottery ticket, a viral meme stock, or a risky investment promising overnight riches. Instead, I would focus on a disciplined, long-term strategy built around education, smart investing, patience, and consistent action. Turning $1,000 into $100,000 is certainly possible, but it is important to understand that it rarely happens quickly and never comes with guarantees. The biggest mistake many beginners make is believing they need to find one perfect investment that will increase 100 times in value. While that has happened in rare cases with companies like Amazon, Apple, or early Bitcoin, relying on luck is not a reliable financial plan. Real wealth is usually built through a combination of intelligent investing, continuous learning, calculated risk-taking, and allowing compound growth to work over many years. In this video, we'll explore exactly how I would approach this challenge if I were starting from scratch today, including the mindset, investment strategies, risk management techniques, and financial habits that could maximize the chances of achieving this ambitious goal. Today, we will talk about how I would turn $1,000 into $100,000 starting today. So, before we start, make sure to hit the like button and subscribe to my channel. Start with the right mindset before investing a single dollar. I would begin by developing the correct mindset. Many people fail financially, not because they lack opportunities, but because they expect instant success. Building substantial wealth requires patience, discipline, emotional control, and a willingness to continue learning. I would accept that there will be market corrections, unexpected setbacks, and periods when investments underperform. Rather than chasing quick profits, I would focus on making consistently good decisions over a long period. Wealth is often the result of thousands of smart financial choices, rather than one lucky investment. Invest in financial education first. One of the smartest uses of part of that initial $1,000 would be investing in knowledge. Learning how financial markets work can dramatically improve investment decisions for decades. I would study topics such as stock valuation, diversification, compound interest, business fundamentals, macroeconomics, behavioral finance, and risk management. Reading books by successful investors like Warren Buffett, Benjamin Graham, Peter Lynch, and John Bogle would provide timeless lessons that could prevent expensive mistakes. Financial education often delivers the highest return on investment because the knowledge gained continues paying dividends throughout life. Avoid get-rich-quick schemes. The internet is filled with advertisements promising to turn small amounts of money into fortunes through secret trading systems, cryptocurrency speculation, forex signals, or unrealistic investment opportunities. I would completely avoid these approaches. History has shown that many of these schemes fail because they rely more on marketing than sound investing. Instead of searching for shortcuts, I would concentrate on strategies supported by decades of historical evidence and proven business principles. Build a diversified investment foundation with the remaining capital. I would begin building a diversified investment portfolio. Diversification helps reduce risk because different assets often perform differently under changing market conditions. Rather than placing every dollar into a single stock or industry, I would spread investments across multiple high-quality businesses or low-cost index funds that provide exposure to hundreds of companies. Diversification cannot eliminate risk entirely, but it can significantly reduce the impact of poor performance from any single investment. Focus on high-quality companies. If selecting individual stocks, I would prioritize companies with strong competitive advantages, healthy balance sheets, consistent earnings growth, excellent management, and sustainable business models. Businesses with powerful brands, recurring revenue, and global expansion opportunities often generate attractive long-term returns. Companies that consistently innovate while maintaining financial discipline may continue growing even during challenging economic conditions. Rather than buying businesses simply because their stock prices are rising, I would evaluate their long-term ability to create shareholder value. Let compound growth do the heavy lifting. Albert Einstein is often credited with calling compound interest one of the most powerful forces in the world. Whether or not he actually said those words, the principle remains true. Compound growth allows investment returns to generate additional returns over time. For example, earning returns not only on the original investment, but also on previous gains, creates exponential growth over long periods. The earlier someone begins investing, and the longer they remain invested, the greater the potential impact of compounding. Continue adding new investments, turning $1,000 into $100,000 becomes much more achievable when additional savings are invested consistently. Rather than relying solely on the original investment, I would regularly contribute extra money from my income whenever possible. Even modest monthly contributions can significantly accelerate wealth creation. This strategy, known as dollar cost averaging, involves investing fixed amounts at regular intervals, regardless of market conditions. It reduces the emotional temptation to time the market while steadily increasing total invested capital. Increase income alongside investing alone may not be enough to reach ambitious financial goals quickly. Therefore, I would actively work on increasing my earning potential, developing valuable skills, pursuing career advancement, starting a side business, freelancing, or creating digital products could generate additional income available for investment. Increasing earnings often has a greater impact on long-term wealth than attempting to earn slightly higher investment returns. Every extra dollar invested today has years or even decades to compound. Reinvest every dollar earned whenever investments generate dividends, interest, or capital gains. I would reinvest those proceeds rather than spending them. Reinvestment accelerates compound growth because every dollar continues working instead of being withdrawn from the investment portfolio. Many successful long-term investors attribute much of their wealth to consistently reinvesting returns over many years. Stay patient during market declines. Market volatility is unavoidable. Even the strongest companies experience temporary price declines during economic slowdowns, recessions, or periods of investor fear. Instead of panicking during market corrections, I would view them as opportunities to purchase quality investments at more attractive prices. History shows that financial markets have repeatedly recovered from downturns, rewarding patient investors who maintain long-term perspectives rather than reacting emotionally. Avoid emotional decision-making. Human emotions often become an investor's greatest enemy. Fear encourages selling during market declines, while greed tempts investors to buy after prices have already risen dramatically. Successful investing requires emotional discipline. I would establish a clear investment strategy before entering the market and avoid making decisions based solely on headlines, social media trends, or short-term price movements. Consistency usually outperforms emotional reactions over time. Learn to manage risk. Growing wealth requires accepting some level of investment risk, but unnecessary risk should always be avoided. I would never invest money needed for emergency expenses or short-term financial obligations. Maintaining an emergency fund separate from investment capital provides flexibility during unexpected situations. Risk management also includes diversification, avoiding excessive debt, limiting speculative investments, and regularly reviewing the portfolio without constantly making unnecessary changes. If you liked this video and would like to see more like it, please give it a thumbs up, leave a comment, and click the button to subscribe.